last one for 10.2. We're just looking at the discussion case, and this kind of brings together inventory, depreciation, and how you might use these two types of differences in how a company records its financial information to compare and see which company is doing best, or to try to bring some comparability between companies. Because if a company uses FIFO and straight line versus LIFO and double declining, there's a definite different philosophy when you're looking at their accounting statements. FIFO is looking at increasing the net income and having it as high as possible in the books, where LIFO and double declining is looking at having the lowest amount of net income so that you pay less taxes. Now, which philosophy is best? I guess that's the decision of the owners of the company. But knowing those things, then you can bring things into focus if you were looking at two companies and they use such opposite philosophies in recording their financial statements. So this is kind of a fun activity. So the first thing, we give you a bunch of information. They've sold 25,000 units, and this is a breakdown of the units. FIFO, obviously, if you look at the information sheet, is going to use the numbers from the top down. So their 10,000 units is going to start at $4 to find the cost. If you're using LIFO, you're going to start at the bottom, and their 10,000 units is going to use $7 as the cost. And this is going to give you the cost of goods sold for each company, which is going to get plugged in right here. They've already given you the sales revenue, so that's a plug here and here. You're going to find the gross profit. They've given the operating expenses at $80,700 for both of them. And now we come to the depreciation. This company uses straight line, and there's a residual value of $20,000. So that's really very easy. You take 143 minus 20,000 and divide it by 10 and come up with the depreciation expense. Now you look at the other one who uses double declining. They do not take the residual into consideration. So it's 143 times 1/10, or divided by 10, times 2 to get the double declining balance. Then you have your total expenses, and it's going to give you your net income. That's going to give you a definite difference between those two companies, as you can see just going down through there. Then the questions become for this exercise is requirement 2. Write an investment letter to address the following questions. Which company appears to be more profitable? Which company has more cash to invest in new projects? Which company would you prefer to invest in, and why? You need to answer those questions for us using all of the accounting skills that you have absorbed to date. I'm really anxious to hear your responses and your reasoning behind your responses. So have fun with this, okay? Think about it. Don't just jump into it and get it over with. This is really what the accounting is all about for you. If you're not going to go on and go into accounting, knowing how to do accounting that we've taught to date will show you how to analyze financial statements between two companies. And when you become a manager or become somebody who's trying to make decisions about buying a company or maybe even investing in a company, you're going to be able to compare and know the reasons which one's best. So we're off and we're done with 10.2. Thank you.